Here's price is about prices in financial markets. And financial market prices are absolutely crucial to the economy because the prices of assets like stocks, bonds, and real estate, they give important signals to firms in what they should be investing in. They give signals to households in what they should save in. And they also affect how much risk is taken in investments and savings in the economy. So because of this importance of asset prices, it's very important to understand how well these financial markets work in pricing assets. Now, if we look over history, we often see very large fluctuations in asset prices up and down. One example could be, during the late 90s, we saw technology stocks reach record highs, and then a few years later, dramatic drops in these prices. So it's very important to understand whether these fluctuations in prices are a sign of something not working correctly in financial markets, because to the extent these fluctuations are due to mispricing, they could have large negative effects on the economy. Now, when you want to understand how well asset prices work, predictability, i.e. whether you can foresee how future prices in financial markets are going to evolve, become a central issue. The picture you see here may look like a stock price index, but as a matter of fact, it's a completely random series. It's what happens if you flip a coin a number of times and you count the number of tails minus the number of heads. So this is a series that you may see some patterns in, but it's a completely random series. Now, it turns out that if financial markets work well, we would actually expect stock prices, for example, or financial market prices to exhibit exactly the same random behavior. The reason for this is that if financial markets work well, then all the new information about, that's relevant for the future value of these assets should be immediately incorporated in the price, so that, you really can't make any money, for example, from reading in the newspaper in the morning that profits of this particular firm is going to be higher in the future, because the price will already have adjusted, and whatever variation we see that's left is going to be random. So there's one exception to that, however, which has to do with compensation for risk. So assets that are more risky for investors, they're going to be less likely, or they are less willing to invest in those assets, and to induce investors to do that, they need to get a higher return for more risky assets. So we would expect stocks to have a higher return because they're riskier compared to bonds or government bonds that are safer. So all of these issues, the issue of predictability and whether that's consistent with financial markets working, is central to these laureates' work. And they looked at predictability in the short run, they looked at predictability over the longer run, partly getting somewhat different results, as you've heard. And the importance of this research is that it really greatly improved our understanding of how financial markets work, when markets seem to work well, when they seem to work less well.